On the surface, waste management looks like an old economy utility with diesel fumes and safety vests. It isn't. Houston, 2024. Once the landfill permits are on the table, this business starts to resemble a regulated toll road with pricing power, local scarcity, and fewer credible competitors than most software markets. The company is led by Jim Fish, a steady operator rather than a charismatic founder. That helps. He came up through finance and operations, served as CFO, and understands route density, disposal margins, and disciplined capital spending. In board minutes, those people age better than visionaries promising a category rewrite. Across the table sit the real players: county regulators, state environmental agencies, municipal procurement officers, and the lawyers who live inside Subtitle D rules. Add Republic Services as the obvious rival, plus hundreds of private haulers. The room is not Silicon Valley. It is zoning boards, transfer stations, and permit files thicker than some merger agreements. The setup begins with a fact many investors skip because it lacks glamour. Waste is mandatory. Recessions reduce volumes in construction and industrial lines, but households still generate trash, and cities still need collection. The service has frequency, contracted revenue, and daily operational relevance. Boards tend to like businesses that remain necessary on bad Mondays. Then comes the scarcity. Landfills are hard to permit, harder to expand, and almost impossible to replace near major population centers. Waste Management's 2024 10K describes 247 active landfill sites and a vast transfer network. That figure matters more than a software company's seat count. Disposal ownership changes the economics of the whole chain. The prior deal many people missed happened years ago, site by site, county by county. A permit extension here, an airspace expansion there, a transfer station acquired at an unlovely multiple. None of it made cocktail chatter at Davos, yet each filing narrowed future competition. The pattern is older than the press. Now the mechanics. Collection looks competitive from the curb. The truck arrives, the bin empties, and the customer sees a service line item. But the margin pool sits downstream. If the company owns the landfill or transfer station, it captures disposal economics, shortens hauling miles, and decides where third parties pay tip fees. That is vertical integration with a regulatory twist. In software, gross margins can look magnificent until customer acquisition costs, churn, and product reinvestment take a bite. In waste, the route, station, and landfill form a local system. Once density is built, each extra stop can be highly attractive. Distance kills that advantage. Geography acts like code lock-in. Look at the capital base and the discount rate. Waste Management spends real money on trucks, cells, liners, gas systems, and environmental controls. That scares away tourists. Fine. When capital intensity protects an incumbent from 10 lazy entrants, shareholders should not complain too loudly. Maintenance CapEx is visible. Competitive destruction in software is often less visible until renewal season. Then there is pricing. Collection contracts include CPI-linked escalators, fuel, and environmental fees. And periodic repricing. Disposal pricing is even better when regional capacity tightens. If airspace is scarce, tip fees move. This is why a landfill permit reads like a long-dated pricing option disguised as environmental paperwork. The friction sits in the liabilities. Every landfill carries closure, post-closure, methane management, groundwater monitoring, and compliance obligations. Waste Management discloses asset retirement and environmental liabilities clearly enough for anyone willing to read the footnotes. This is where tourists leave the room. The hidden liability is not hidden at all. It is merely boring. Another point of friction is politics. Nobody wants a new landfill nearby. Everybody wants trash removed by Tuesday morning. That contradiction gives incumbent operators a peculiar form of protection. New permits face lawsuits. Local opposition, traffic concerns, odor complaints, and election year speeches. Existing permitted assets become more valuable each time a proposed site dies in public comment. There is also technology anxiety. Investors hear recycling automation, route optimization, AI-enabled dispatch, methane capture, renewable natural gas, all useful. None changes the hierarchy of value. Software can improve labor efficiency and fleet utilization. It does not conjure fresh permitted airspace near Atlanta or Phoenix. The permit still outranks the app. The market result has been quietly remarkable. Waste management has produced durable cash flow, dividends, buybacks, and respectable organic pricing for cycles that damaged much more glamorous sectors. When inflation rose, the company had levers. Many boards rediscovered that recurring revenue without durable pricing authority can become a very long meeting. On earnings calls, management often sounds almost annoyingly calm. That, too, is informative. Calm operators discussing yield, retention, recycled commodity offsets, and disposal volumes usually have a grip on the machine. Grand language generally signals a hole somewhere. I learned that around 1999, and the lesson has held up rather well. Many software businesses sell annual contracts into crowded categories with low switching pain, rising customer acquisition expense, and features that migrate across competitors in a quarter or two. The code may be elegant, the moat may be fictional. Waste management's moat requires permits, acreage, geology, local approvals, and years. That is a different standard. I have seen a related pattern before in railroads. Burlington Northern and Union Pacific owned rights-of-way that looked dull until logistics strained the network. Then the market remembered that replacement was fantasy. The asset is worth what the next buyer will pay for it, and many strategic assets have no realistic next builder at all. I have also seen it in aggregates and cement. Martin Marietta and Vulcan held quarries near growing metro areas with reserves and permits nobody could replicate quickly. The stone looked commodity-like. Location and authorization made it otherwise. Waste management plays the same hand, except the material arrives every morning without a marketing campaign. What 30 years in the room taught me is simple. Boards regularly overpay for optionality and underprice permission. A software roadmap can impress a strategy committee for an afternoon. A landfill permit can defend cash flow for decades. The price is the easy number. The price is never the deal. Waste management is valued like a steady public company because the optics are mundane. The underlying asset base behaves more like controlled infrastructure with private market scarcity. I have seen this before. Here's what it means. Who's running this same playbook today?